For more on where to find opportunities in retail and e-commerce, let's bring in John Sanmarco from Neuberger Berman and Nikhil Devnani from Bernstein. Good afternoon to you both. John, I'll start with you because the MasterCard numbers to me are very indicative of the fact that you have a consumer that's still going out there, that's still spending, but not at the huge and fervent rate that we saw over the last couple years as we were coming out of the pandemic. Is this a last gasp in spending or before things slow down more materially, or is this a return to something more normal finally coming out of the pandemic?
Thanks for having me on. And I think the latter. I think this is, boring in the best possible way, or certainly in a good way. We've achieved kind of the new normal. Wallet share shifts from services to goods. That's kind of stabilizing a bit. As you mentioned, some of the disinflationary impacts from gasoline and food prices, and that should help the discretionary budget as well. So we think that the environment's lukewarm, and our outlook for 2024 is for the consumer spending to remain lukewarm in this 3 to 4% range.
Okay. Nikhil, do you see it the same way, especially given the fact that, coming out of the most recent retail earnings season, you have consumers continuing to get more selective. They're much more focused on spending on their needs rather than their wants, much more deliberate with purchases. But on the flip side of that, we've seen so much inventory destocking that at least some companies have said they haven't had to mark down or discount as aggressively as maybe they had earlier in the year.
Yeah, look, I focus on the e-commerce vertical, and I think boring is good is probably the best way to put it. What we've seen this year is that growth has been pretty stable. But what's working right now is aggressive promotion. So what we're seeing, at least in the online space, is a very promotion-heavy environment. Consumers are being selective. They know that there are deals to be had and gone after, and they're waiting around for those deals to come through. And so they're engaging when there are sales and discounts on there, but not so much when there aren't. And so I think that sets up, again, for an environment that's okay, but not necessarily super robust. Keep in mind, e-commerce used to grow 12, 13, 14% pre-COVID. Right now, it's doing about 8%. So it's somewhere in between, the lulls of coming out of that COVID hangover and still getting back to what we would consider normal as we look ahead.
Okay. John, I want to get your thoughts on what represents an opportunity, an investing opportunity as we look to 2024 in retail.
Sure. Dollar Tree is our largest position in the next generation connected consumer fund, and we think investors have really got hung up there on their Family Dollar banner that they own. It's less than 10% of EBIT, and it's admittedly sort of been a choppy turnaround. We frankly believe that things get better in the new year. There'll be some stabilization in SNAP government assistance funds. But the real story here that kind of gets lost in the controversy around the Family Dollar banner is this Dollar Tree banner, which is almost all of profit and has just been a really great story. That mid-single-digit consumer traffic growth. They've been rolling out multiple price points with a lot of success, and in so doing, they're attracting a more affluent consumer who, over the long run, just going to be able to open up their purse strings quite a bit more and shop the whole store and be a more profitable customer. So we think, some of that goodness is getting lost in the controversy at Family Dollar, and you're getting a very reasonable valuation on what is mostly a business performing very well and positioned quite well for the environment.
Okay. Nikhil, going back to the e-commerce piece of this, the fact that maybe we're not seeing the torrid growth of the last couple of years, but still robust growth, I'll call it, for e-commerce versus broader retail. What are your top picks when you look to 2024, especially in an environment where you have Etsy filing a restructuring and citing macroeconomic uncertainty?
Yeah, actually, funnily enough, we don't have any top picks on the e-commerce side. We're actually starting the year relatively cautious on this basket. And keep in mind, I cover discretionary names like an Etsy. And those are the buckets of e-com and retail that are being hit a little bit harder right now. A company like Amazon is doing a lot better because it sells essentials. But companies that sell home goods, for example, like Etsy and Wayfair, which I cover, are a little bit finding a little bit harder to grow right now. And so as we look into next year, we've had significant amounts of multiple expansion in the last 2 months alone, given the interest rate outlook has changed so much. And so you've had these stocks run up a ton. done. It doesn't feel like the fundamentals have moved with it. And so we're starting the year with a bit more of a cautious stance as we look into 24. Now the fundamentals have to keep up with where the expectations are going. And that might be a tougher thing as you roll forward through kind of the upcoming quarters here.